Stars that twinkle in the night so bright, guiding paths with gentle light. Echoes of the past we hear, carried on the wind so clear. Colors blend in harmony, life's a vibrant tapestry. Every beat a story told, ancient wisdom pure as gold. Let the rhythm take you high, raise your hands up to the sky. Feel the energy ignite, celebrate the day and night.
Hi guys, welcome. We're gonna start shortly, right? So, just give it a couple of minutes for people to join. So thank you for joining. We appreciate
that. Rise of the sun in the morning light, drums in the distance take flight. Heartbeats echo through the trees, dancing shadows in the breeze. Feel the pulse of the ancient land, footprints mark the golden sand. Voices harmonize the song, nature calls and we belong. Let the rhythm take you high, raise your hands up to the sky. Feel the energy ignite, celebrate the day and night. Stars that twinkle in the night so bright, guiding paths with gentle light. Echoes of the past we hear, carried on the wind so clear. Colors blend in harmony, life's a vibrant tapestry. Every beat a story told, ancient wisdom pure as gold. Let the rhythm take you high, raise your hands up to the sky. Feel the energy ignite, Rise of the sun in the morning light. Drums in the distance take flight.
We see it back obviously when we when we come towards the end. So hopefully all of you can hear me well. Yeah, am I correct? You can hear me. If yes, if you can type in the chat, that'll be fine. And then I'm sure we have. I think Cami is also here. So Cami, I think the team is a little bit late. So Cami, if you, I know you can hear me, but if you help me in actually accepting people into the meeting, so just let them in. That'd be great. So if that's great. So we're just gonna make a general start, guys. So pleasure to see you here. So excited to for another great conversation that we're gonna have, right? So first of all, let me check that everybody can hear me, right? You can all hear me, right? So if yes, if somebody can say something in the chat, and that'd be good, or raise your hand, say yeah, so that I could see that it's all okay. Okay, it looks like it's good, brilliant. That's fine. Excellent, guys, excellent. So I want to start by a question. So, and the question for me, which I want to ask you guys, is what is the true value of a startup? That's a question, especially a startup that is focused on tackling climate change. Yeah. So what is really the true value? Because valuing startup, it's always a challenge. Let's admit that, right? Especially startup that comes from the continent, because we have limited data, we have market uncertainties, and also what we have is evolving business model that actually makes the process complex. And for climate focused startup, the challenge is even greater, as I was alluding to, because traditional valuation method don't always capture, the full impact of sustainability driven ventures. And what it does is it leaving both founders but also investors, with a critical gap that they have to navigate. And that's exactly what I would like us to discuss today. So, welcome to Valuing Startup Guide, the challenges and best practices in valuing climate focused startups. So, some of you may see me for the first time, and if that's the first time attending our conference, so our webinar, so welcome. So, my name is Tony Teo. So, I'm the founder here of Renewables in Africa. What we do is very simple: raise awareness about renewables energy, but also sustainability across the globe. So what we want to do is to help as many businesses as possible to tap into the potential that we have here. So so that we could obviously exploit that. Yeah. So if you're looking for visibility, if you're looking for lead, if you're looking for deals, we support you. We are your eco bridge to tap into the African market, and we also your eco bridge if your company looking to decarbonize. Yeah, you're looking for a sustainable pathway. If you want to have carbon footprint assessment, carbon reduction strategy, definitely reach out to us, and I'll be more than happy to talk to you and show you what we've done for other people. But over the 90 minutes that we together, in fact, less than 90 minutes now, right? Because obviously I like to respect your time, make sure we finish when we should be. So we're going to be exploring some proven techniques for assessing startup values, unpacking some examples, and hear insight from the experts from Numerous, who is just fantastic company that already delivered two. It's a world-class webinar, so they're back again at it, and I'm sure you'll be delighted. And stay right to the end, so I'm sure you will like what you see. But before we begin, so you know me, right? So I like to obviously get you involved and find out what do you know and how can we improve what you know, or maybe complementing what we know with your knowledge. So I want to start with a quick poll survey to get a sense of where everyone stands in terms of startup valuation, because we're not on the same page, right? Some are more advanced than others. Yeah, we want to find out. We're going to take that into consideration so that when we provide responses to you, those are measured and they respond to some of your queries. And your response will really help in shaping today's discussion. So I really would encourage you to really participate, and that would be great. So let me just launch now the survey, and you guys could tell me. So let me just, you should be able to, no, sorry, let me go back and say that's it. That's the one I want to share. So you would see the poll survey that's coming right now. Please, 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 so jump at it. So those are 3 questions. So simple questions. So I like all of you, to be honest, guys, to to participate. So what is the biggest challenge in valuing startups? So that's what I'd like you to tell me. So is it lack of financial data and projections, high market uncertainty, difficulty in benchmarking, comparable companies, subjectivity in assessing risk? What do you think? Yeah. So, and the second questions. Oh, that's yeah. Sorry, the second question: how familiar are you with startup valuation method? So, very familiar, somehow familiar, limited knowledge, not familiar at all. So, tell me, guys, where do you sit? Yeah. And the last one is, what is the most critical factor investor consider when valuing climate-focused startups? Is that market potential? Is it financial performances and projection, environmental impact and sustainability metrics? Hey, you tell me. So I'd like to hear from you. And then yeah, so I'm just gonna leave the poll, let's say, for a minute or two, just to get as many contribution as possible. Please, guys, contribute, participate, because as I say, we really want to deliver quality information for you. We want to respond to your queries, and it's good to understand where you are sitting. So don't be shy. Yeah, I can see I have already 20 people, 21 people. That's 23. Yeah, keep them climbing that. Yeah, so I like to see at least 30. Come on, guys, if no more than that. Yeah, we're getting close. We're having 26 because I have uh, not Camis, Retendo and Edna. Those obviously they would like to see that, to get an idea what you are thinking, and then they come back. Yeah, we are 29. Come on, there's 47 of us. We can do more than that. Yeah, even people that don't have a startup, just share your opinion. Let us know what you think. Yeah, so I'll leave it for another 45 seconds and we will stop. We move on so that we also take into account the time. So we have 30, 31 now. Great. We got more than more than more than 30 like I wanted. Excellent. This is brilliant. So another 30 seconds and we will stop and we move on. So by the way, while we're doing that, feel free to keep on introducing yourself into the chat. Let us know so who you are, where you're joining from, and then I like it to be interactive. So make sure that you have questions, for us, and we'll be delighted to respond to your questions. So don't be shy. So that would be good, right? So another 5 seconds, free, yeah. So we have 37. Can we get to 40 maybe? Okay, I'm not gonna leave it there. I'll stop at this point. Yeah, that's fine. We have 37 people that responded. That's good enough. Let's stop them. Let me just stop it now and share the results so that we could see. So the results are in, guys. So what is the biggest challenge in valuing startups? So numerics, guys, you want to look at that clearly, right? So that I'm sure is interesting. So we have 38% of people believe that the lack of financial data and projection it's the biggest challenge when you value a startup. So you would tell me, because I don't know how much expert we have in the room. I don't know. We see later when we analyze the data. So we then have difficulty in benchmarking comparable companies at 30%. Subjectivity and high market uncertainty, that's obviously at same level. That's what we're seeing here. But clearly lack of financial data and benchmarking against comparable companies, that seems to be the challenge that we're seeing here. Okay, brilliant. Now what do we have? We have now, how familiar are you with the startup valuation process? That's what I want to see. We have 41% that say limited knowledge, somehow familiar. Yeah, so you see. So okay, we have people that kind of have an idea. So I suspect many of them may be business owners themselves. Yeah, maybe they would have gone through this process as well themselves. That'd be good because between the somehow familiar and the limited knowledge, we have over 70%. And then what do we have is what is the most critical factor investors consider when they value climate focused startups? And then here, obviously, is a little bit more distributed. And what we see here, it's 29% environmental impacts, sustainability metrics, but then you have markets, potential, scalability, financial performances, experience of the finance team. Okay, brilliant. So I'm hoping that my fellow, let me just take it away. I'm just going to stop sharing now. So thank you very much. That was great, great, great contribution. I think I'm very pleased with what I've seen. And I'm hoping that my colleague here, so both Rutendo and Edna, so have seen that, and we definitely want to say a thing or two. So maybe that's the right time for me, right segue to move into that short introduction of our speakers. So Edna, Rutendo, can you hear me? Did you see what I saw? What's your
Hi,
opinion?
Tony.
What do you think?
Yes, we did.
Yeah,
Great
okay.
insights there. And
Okay.
I think it's an interesting bunch that we have, and it's going to be very lovely unpacking all of those elements. And I think after this webinar, everyone should sort of see where they fit, what they got right or what they got wrong. But interesting responses. Thanks, Tony.
Okay, excellent, excellent. Edna, what about you?
I'm glad to see that we have such a huge number here with us today. We are grateful for you for making the time. And I hope that our presentation is going to address some of your concerns, at least to a satisfactory level. We have some good things ahead.
Yeah, usually webinar with you guys are always very good, right? And always well attended. So no pressure. Yeah. So that's fine. So that's the right time for me to say that I think we have a short presentation for numerics that we want to go through, and after that we'll. Oh, by the way, guys, before we jump into that, my bad. I think what I should have done is maybe to tell our lovely people here. So what's going to be the program roughly? So I haven't done it. Let me just get a chance to do it quickly, and then we can move on. You can see how excited I am, right? So, what we're gonna have here. So, very quickly, it's Edna and Rutendo from Numeris who's gonna go through the presentation. So we've just done the welcome and the intro plus the poll. We're now gonna look at the short presentation from Numeris that they put up together, and then we're gonna have a number of questions that we're gonna respond to, a point that we're gonna address, talking about the valuation of startups, and after that, explore a little bit the climate finance ecosystem. And as I say, I really also want to get you guys involved. Please, please, please do me a favor. So make sure that you have questions, because I can't bring world-class expert like Edna and also Rutendo in front of you guys and you're not having questions, right? So you saw sometimes some of you asking for free information. This is free information. So make sure that you have your questions. And we're gonna finish up with exit survey at the end, and then we're gonna wrap up. So that's the program we're gonna go through today. Yeah, so it should take us to, like I say, to 12:30 my time, and then I don't know what time zone you're into, but like I say, we have now what I would say about 75 minutes left maximum, and then we can move on. So I go back to you, so Ritando, and then Edna. I don't know who's gonna do the presentation, but please, if you can also take the chance to briefly introduce yourself at the beginning before you can kick off the presentation, but it is over to you.
Great. Thanks, Tony. Edna will do the presentation for us. So just a 1 second intro. My name is Rutendo Chiangwa. I'm a director within the Numeris team. I focus on valuations. Over to you, Edna.
Okay.
Hello, everyone. Good morning, good afternoon, good evening from wherever you are. My name is Edna Mugambi. I'm based in Nairobi, Kenya, and I'm an analyst at Numeris.
Excellent. Super.
Awesome.
So
thanks, Tony. I think let's get started into the order of the day. So good day, ladies and gentlemen, and thank you. It is an absolute pleasure to have you join us for this webinar where we discuss the valuation of startups. In this webinar, we're presenting to you as Numeris. We are a specialized valuation and financial modeling provision entity. We focus on projects and transactions that deliver impactful changes in Africa, which is also aligned to the United Nations Sustainable Development Goals. Our services cut across various industries, looking at the flow of capital to critical sectors in order to prepare Africa for growth, of which clean energy is a big focus for us. We also play in the infrastructure, agriculture, education, and healthcare space, aiming to make an impact through our services. Our valuation services include fairness opinions, business valuations, IFRS valuations, and valuation reviews, while our focus on the financial modeling side is M&A modeling, financial model builds, and model reviews. Our team is made up of a number of professionals that have many years of experience in transactions across different sectors and geographies globally. Our leadership team is made up of Ruben in Mauritius. He focuses on financial modeling and valuations. Nathan in India, who specializes in valuations, and myself, Rutendo. I am based in South Africa and I also focus on valuations. Now, the leadership team is supported by an assistant manager, Gabriel, who's also based in South Africa, and two analysts, Kame and Edna, who are both in Kenya. Together, we form the core team that provides financial modeling and valuation services for Numeris. Some of our key credentials on the projects that we've worked on include infrastructure modeling, where we've provided services for wind and solar farms across Mauritius and South Africa. We've engaged in university housing projects in Nigeria and waste recycling plants in Mauritius. Our valuation service credentials include valuation for fundraising purposes, M&A valuations, and purchase price allocations. Right, moving on to today's webinar, we want to focus on valuing startups, and our objective today is to discuss the valuation methods and approaches typically used in valuing startups. We want to highlight strategies to overcome typical challenges when valuing these startups, such as the major issue, the limitation of data, especially with early stage valuations. We want to share insights into assessing startups effectively in order to better investment decisions. And lastly, we want to share some critical drivers behind the startup in valuations today. Right, let's look at our introduction and focus right at the valuation of climate-focused startups. There's been a sharp increase in the number of climate-focused startups. According to International Energy Agency, IEA, clean energy investments are focused to reach $1.4 trillion globally by 2030, highlighting the growing importance of climate innovation. Despite these potential, startups still face considerable hurdles when it comes to valuations. By incorporating new methodologies and focusing on both financial and societal impacts, we can improve the accuracy of startup valuations in this dynamic yet crucial sector. In today's webinar, we will dive into these challenges and explore some practical strategies for overcoming these challenges. We hope to equip you with tools and insights needed to better navigate the valuation of climate-focused startups and help drive impactful investment decisions in the fight against climate change. I'll now hand you over to my colleague, Edna, to talk about climate finance solutions. Edna?
Thank you, Rutendo, for that introduction. Now let's talk about what climate finance is. And here we're referring to the financial resources allocated to support activities aimed at mitigating climate change by reducing greenhouse gas emissions and also adapting to its impact. These resources are the public, private, and alternative sources of funding directed towards projects such as renewable energy development, sustainable agriculture, climate resilient infrastructure, and conservation initiatives. There are two main subcategories based on different aims, as you can see highlighted on the slide. We have mitigation finance, which is investment that aims to reduce global carbon emissions, and adaptation finance, which facilitates response to the consequences of climate change. We've noted that globally there is a much greater focus on mitigation, which accounts for over 90% of spending on climate. Renewable energy is an important growth area for mitigation investment and also has growing policy support. It's widely recognized that public budgets will be insufficient to meet the total needs for climate finance, so private funds will be important to close that gap. There are many different financial models that have been used for financing climate action, and there is also considerable innovation in the area. Examples of such instruments are green bonds, carbon offsetting, and payment for ecosystem services. These will be further elaborated shortly. There are also solutions which were not specifically developed for climate finance, but have been transferred to that area. For example, PPPs, which are public-private partnerships, and blended finance. So here are some examples of climate finance solutions. First, we have green bonds, which are debt instruments issued to raise capital for environmentally friendly projects. These bonds are typically used to fund projects that have positive environmental benefits, such as renewable energy, energy efficiency, and other climate-related infrastructure. Most green bonds for climate actions are asset-backed or ring-fenced, which means that investors have been promised that all the funds raised will only go to specified climate-related programs or assets. Like normal bonds, green bonds can be issued by governments, multinational banks, or corporations, and the issuing organization repays the bond with interest. The main difference here is that the funds will be used only for positive climate change or environmental projects. This allows investors to target their ESG goals by investing in them. They are a bit similar to sustainability bonds, but those also need to have a positive social outcome. Examples of institutions that are issuing such bonds are the World Bank, the European Investment Bank, and on the corporate side, we have Tesla and Apple, which issue them to finance their sustainability goals. Next, let's move to climate funds, which are established to support the financing of projects and initiatives aimed at addressing climate change. They often come from governments, multilateral institutions, or international organizations, and can be used to promote both mitigation and adaptation strategies. Examples are the Green Climate Funds, which supports developing countries in reducing emissions, and the Global Environment Facility, which facilitates projects related to climate change mitigation, biodiversity, and sustainable development. Next, we have carbon offsetting, which is a trading mechanism that enables entities to compensate for offset greenhouse gas emissions by investing in projects that reduce, avoid, or remove emissions elsewhere. When an entity invests in a carbon offsetting program, it receives a carbon credit or an offset credit, which accounts for the net climate benefits that one entity brings to another. After certification by a government or independent certification body, credits can be traded within countries. And note that countries or entities, really. One carbon credit represents a reduction, avoidance, or removal of 1 metric ton of carbon dioxide or its equivalent. And finally, we have payments for ecosystem services, which are incentives offered to farmers or landowners in exchange for managing their land to provide some sort of ecological service. They are also known as payment for environmental services or benefits, and have also been looked at as a transparent system for the additional provision of environmental services through conditional payments to voluntary providers. This program promotes the conservation of natural resources in the marketplace. So now I'll hand over to Vitendo to discuss valuation methods.
Great, thanks, Edna. So I'm going to lead by a statement there, a quote that says, valuing a startup is as much an art as it is a science, requiring both quantitative methods and qualitative judgments. I think this statement reflects common sentiments, shared knowledge in the investment community, particularly in discussing venture capitals and private equities. It recognizes the inherent risk involved in startup valuations, which stem from uncertainties surrounding factors such as market acceptance, competition, and the company's ability to reach profitability. The unpredictable nature of these elements can make it challenging to establish precise value, requiring careful consideration of both quantitative elements and qualitative insights. There are a number of differences that we can note when performing a valuation of a mature company versus a startup company. One of the factors I can talk about is data availability. For a mature company, it has recurring revenue streams, often with a predictable growth trajectory. They have comprehensive financial information and historical data on which valuations are based on, which would be the balance sheet, the income statement, and the cash flows. On the other hand, if you look at a startup, the revenue is typically unpredictable with high uncertainty about future cash flows. There's a limit to the historic data available, and there's a lot of reliance on assumptions. So startups rely more on qualitative factors and market potential, which is often risk-adjusted return models or market comps in their valuations. Okay, let's look at a concept of pre-money and post-money valuation. By understanding both pre-money and post-money valuation, stakeholders can better navigate the financing process and assess the fairness of deal structuring. The pre-money valuation establishes the value of a company prior to receiving new investments. It serves as the baseline of negotiations, determining the ownership percentage of investors based on their contributions relative to the company's pre-financing worth. The post-money valuation includes money that has been raised following the funding round. So in there, we've got a formula that states the post-money valuation is equal to the pre-money valuation that would have determined or calculated, and an addition of the financing that has been raised. I'll just hand you over now to Edna, who will talk to us about the business life cycle. It's important to note that within the startup space, much of what you receive in the form of funding depends on the stage along the business life cycle where you sit. Over to you, Edna.
Thank you. So, like she has mentioned, the business life cycle framework highlights the evolving nature of climate finance options as firms progress through their growth phases. So there are various factors affecting accessibility of climate finance at each stage. I'll just quickly run through them. One, we have track record. So we find that early stage businesses such as startups face challenges in demonstrating credibility compared to mature firms. Two, policy support. So access to funds also depends on incentives like tax benefits or grants in some specific regions. Three, there's also investor appetite. This is something that varies across the stages, with risk tolerance being higher in seed and startup stages. And four, there are climate impact metrics. So the ability to measure and communicate impact improves access, especially from ESG-focused investors. So as you can see here, I have laid out the various stages through seed, startup, growth, maturity, and decline stage. The important thing to note is that in earlier stages, there is high risk, immense capital requirement, and little to no revenue. The sources of funds available include angel investors, family and friends, VCs, crowdfunding, grants, and impact investors. As we progress to growth and through maturity, operations and market presence become established, and capital requirement is to facilitate scaling and efficiency. Revenues are growing or approaching stability, with business risk being markedly reduced compared to previous stages. At this point, firms can access funds from PE firms, corporate green bonds, commercial banks and institutional investors, DFIs, and even through an IPO. As the growth curve begins to decline post-maturity, the business may need to be reevaluated and consider maybe developing new tech or venturing into new markets. And now, while access to funding is limited at this stage and contingent on demonstrating a viable renewal strategy, the firm can consider restructuring its loans, strategic M&A, or transition bonds, which are meant to support older carbon-intensive businesses moving towards greener practices. Let's now talk about the funding rounds typically followed by VCs. First, we have the pre-seed and the seed stage. This round consists of close friends and family of the entrepreneurs, as well as angel investors. There are more seed stage VC firms that have emerged in recent years, but the area remains niche and is typically for unique situations like first-time founders with previous exits, pre-existing relationships with the firm, former employees of the firm, and the like. We move on to Series A. This includes early stage investment firms and represents the first time institutional investors are providing financing. Here, the startup's focus is on optimizing its product offerings and the business model. Series B and C rounds represent the expansion stage and comprise predominantly of early stage venture capital firms. At this point, the startup has likely gained tangible traction and showed adequate progress towards scalability for success to seem achievable, meaning that they have proven product market fit. Series D and beyond rounds represent the growth equity stage, in which new investors provide capital under the impression that the company can have a large exit, for example, undergo an IPO in the near term. A notable mention is bridge financing or pre-IPO round. In some cases, there is a funding round between late-stage funding and going public. The funds raised are meant to cover gaps before an IPO or acquisition. Now, there's some notable examples of funds that have raised money, especially within the later series of funding. We have Persistent Energy that is based in Kenya that raised 10 million of Series C funding. And there's a company called Ascend Elements based in the US that raised 162 million in Series D funding just last year. So I'll hand back over to Rutendo to make some other few concepts quite clear.
Thanks, Edna. I think let's dive into this matrix, which is called the valuation versus traction matrix. It serves as a valuable tool for both investors and entrepreneurs to assess the worth of a startup by considering its level of traction and market development. The framework outlines the relationship between a startup's valuation and the level of traction that is gained over time from idea phase right through to revenue generation. By evaluating where a company stands within this matrix, founders can make better informed decisions regarding funding strategies, setting realistic goals, and designing effective growth plans. It provides a clear perspective on how to assign business value with actual market performance. Let's look at the first quadrant there, which is termed the lower value quadrant. In this quadrant, we have low traction, but a high valuation. This can be seen in cases where there's significant investor confidence or investor interest and a strong management team, but the business model is yet to be tested. Normally, startups formed by famous founders are positioned in this quadrant. It's considered a low value quadrant because the growth potential of startups is yet to be tested and as such considered riskier. Next, we look at the high value quadrant. In this quadrant, we're talking of high traction, but a low valuation. Startups here have high growth potential because from idea phase right through to revenue generation, there's been significant movement, but the market hasn't been validated as yet. So there's a lot of growth potential in these entities. We can also look at the low traction, low valuation quadrant. This is an early stage startup quadrant without any significant user base or without any significant revenue. You typically find those startups in that quadrant. The last quadrant I'll talk about is the high traction and the high valuation. Startups in this entity, in this quadrant, are typically close to scaling. They've already revenue generative and have a strong product market fit, and significant early revenue and user adoption has been applied. When a startup receives support or assistance from climate-focused solutions, such as the ones that Edna talked about, it can have a significant effect on the value potential through the access of capital. Climate finance often provides startups with funding opportunities from specialized investor knowledge who focus on sustainability and climate impact. This capital injection can raise the company's valuation, especially in the climate finance solution, of a competitive advantage, i.e., because you've got the climate finance solution presented to you, you are placed more or seen more competitive than your peers. The second effect is the potential of de-risking a startup through the support. The backing of climate finance solutions may reduce some of the perceived risks around environmental or regulatory uncertainties, leading to higher confidence among investors. This de-risking effect can also contribute to higher valuations compared to startups that are not backed with such incentives. We now go into the detail of discussing the valuation methods, and what we've done is split the methods into a pre-revenue valuation section and a post-valuation and a post-revenue valuation method. For each method, we will provide an illustrative example and discuss some strengths and weaknesses of each. Okay, the first method we'll talk about is the Baucus method. This is a straightforward valuation approach commonly used in early stage startups, especially in the absence of reliable financial data. This method doesn't make use of any complex financial projections or formulas. Instead, it uses a subjective, expert-driven approach. It assigns monetary value to qualitative aspects that are considered to contribute to the startup's potential success. The qualitative factors considered are the business idea. This is the basic value of the startup. The business idea is what starts to begin with, so that forms our base value. The second factor is the quality of the management team. A venture capitalist or angel investor would first check the founder's experience and track record. A good management team has the effect of reducing the execution risk. Next, we look at the prototype development. This is a critical factor because the prototype is a replica of the actual concept. A good prototype has the effect of reducing tech risk. The other factors we look at include strategic relationships and product rollout or sales plan. We've incorporated an example where we consider a Kenyan agri-tech startup company that's being valued using the Baucus method. We've assumed that the comparable groups in the comparable group companies that match or are similar to this agri-tech company are valued at $250,000. And each of the qualitative factors I've just mentioned is allocated 50,000. It is a principle within the Baucus valuation method to do an equal allocation to each of the qualitative factors highlighted. So based on the scoring, the first element we'll look at is the business idea. So the concept is we want to improve food distribution and promote underserved regions through the use of technology. And this idea is considered sound. Therefore, we score 20% of the valuation to this category. The management team is assessed as strong, and we also allocate 20% to this factor. The prototype has been identified and is functioning well. We also attribute 20% to this factor. Due to challenges like limited access to funding, poor infrastructure in the rural area, the Kenyan startup has not started the product rollout. Therefore, we allocate 5% to that. And there's a relatively small domestic market. We also allocate 5% to that category. A summation of these qualitative factors gives us a cumulative 70%. So we're saying the startup is 70% of the market or the peer set valuation of 250, and this gives us 175 million for the startup in question. The startup is considered riskier than its peers due to the weak scoring under the product rollout and the market challenges that it faces. Let's look at some pros and cons. The advantages of this method is it's simple and it's easy to use. The method makes the user think about corporate governance and risk management considerations, especially when you're assessing the quality of the management. Some of the disadvantages that we look at, it oversimplifies the calculations, and you require some skill in order to allocate correctly the scoring. It is worth noting that for a more robust valuation, it's recommended to combine the Berkus method with other valuation methods that are quantitative and risk-adjustive in nature. The Berkus method typically leads to a higher valuation because it emphasizes optimistic and yet plausible assessments for a startup business. Okay, let's move on to the scorecard. The scorecard method, it provides a structured approach to valuing a startup, offering a way to break away from the valuation processes and giving these a clear view for each of the components. Its nuanced approach takes into account various factors such as the team, the product, the market size, competition, sales channels, and other qualitative aspects. However, scoring companies across dimensions is highly subjective, and challenges of finding reliable comps and setting a maximum valuation is part of the inherent limitations of this method. Additionally, the choice of parameters and the selection of the comps play a critical role in the final valuation, making it important to handle this aspect with great care. Let's look at how the scorecard method works. Firstly, we find a group of suitable comparable startups, and we use this to determine the average pre-valuation of pre-revenue startups in the geography and industry. This provides a benchmark for evaluation. Can you hear me well? Sorry. Perfect. Next, we want to assign weighting to each of the identified evaluation factors. Thereafter, we assess the target startup entity across each of those factors. And then once done, we calculate a factor strength, which is the assigned weight multiplied by the evaluation impact. Lastly, we determine the target valuation by multiplying the benchmark valuation with the total factor strength to arrive at this valuation. Let's move on to an example to explain this. Okay, we've considered a Nigerian tech company that focuses on mobile payments in a region where smartphone adoption is growing, but is still low compared to other developed countries. When using the scorecard, the investor may look at factors like the strength of the management team, the startup's ability to scale, and market potential. The investor may also consider factors such as regulatory changes and competition from traditional banking services, i.e., because of the service that it's offering. As a result, the valuation can vary significantly based on the investor's weighting of these factors rather than the clear industry comparables or historic data. So in this example, we'll see that the strength of the management team and the size of the market have been scored highly because we have evidence that supports that for this startup company, we are outperforming the market. So we've scored in excess of 100%. However, the other 12 evaluation factors have been scored lower than 100% because we feel there's a bit of a risky element when compared to the comps. We then calculate a strength factor, which as said is a multiplication of the maximum weighting and the target status to give us the strength factor. A summation of the strength factor compared to the summation of the strength factor multiplied by the value of our target group of comparable companies gives us 97% multiplied by the assumed $50 million, which is the value of that group. And as a result, this Nigerian entity can be assumed to have a valuation of 48.5 million. Let's move on to the pros and cons for the scorecard method. So it focuses on different categories and can be adjusted differently, i.e. the weighting is different for each of the factors, which puts it ahead of the Berkus method. With the Berkus method, you'll note we allocated 20% to each of the 5 categories. Secondly, this scorecard method allows for a more balanced approach by benchmarking against industry norms, which lead to different moderate to high valuations, depending on what the startup's strengths are. Some of the disadvantages include that it carries the risk of subjective bias and oversimplification. Okay, the next method we're going to discuss is the risk factor summation method. It evaluates startups by assigning scores to various risk factors, such as sales and marketing risk and financial risk. In the African context, where issues like political instability, regulatory hurdles, weak legal frameworks are more prominent, valuations are typically adjusted to account for these increased risks and uncertainties by impacting the valuation downwards. I'd like to discuss 4 steps that we can consider when applying the risk factor summation method. The first step is to identify the key risks that would affect the startup's future performance. Once the key risks have been identified, we assess how well the startup addresses each of these risks. A score is normally assigned to each of these factors, which is ranging from -2 to +2. A -2 is defined as a high risk, and +2 will be a low risk. Thereafter, we assign and attach a value to the sum of each of these scores. Lastly, we adjust the base valuation with the summation of the adjusted scores to see what our valuation will be. A negative cumulative score indicates that the startup is riskier and will result in a lower valuation, while the positive score implies that the company has a lower risk profile, which will lead to a high valuation. We've got here an example where we've listed risk categories and scored them. In the second column there, I'm performing a valuation for a African-based fintech company, and we've assessed risks across each of those categories and have assigned a scoring where +2 is the maximum and -2 is the least. So a -2 is the riskiest, and we've assessed based on the performance and based on where we see major risks within the entity, resulting in a total score of -8. We've also assumed that each point is assigned a value of 50,000, and a multiplication of the -8 and the 50 will give us an adjustment of 400,000. And we've assumed that our comparison base group has a valuation of 3 million. What this is actually telling us is the entity in question is considered riskier than the peer set or the group of comparable startups that we're assessing it against. As a result, our valuation for this African tech startup company will be 2.6 million, being the difference between the peer set valuation of 3 million and the adjustment of 400. If we assume the same assumptions and bring up a second scenario with a startup number 2, which carries exactly the same assumptions, carrying out the same business, but has one exception. The second entity in question follows environmentally friendly operating methods, and as such is a beneficiary of one of the climate finance solutions available. This business or this startup will be valued higher than the first one, because if we look at those risk categories in the scoring, they stand to benefit because the second setup is seen as more reliable and has market confidence. So where we've scored the first entity low in this instance, because of the positive or the environmentally friendly operating methods that are at play, as well as the funding that they receive, this entity finds itself being scored higher than the first one. As a result, we've got a concluded value for this startup at 3.25. Some of the pros and cons for this method are the method is adaptable to different industries and startup stages, making it suitable to value a wide variety of early stage entities. It allows for clear and transparent valuation adjustments based on perceived risks. The risk factor summation focuses on identifying and quantifying risks, which leads to a more cautious valuation. This method is more conservative and adjusts for uncertainties inherent in early stage companies. Some of the disadvantages include that it's subjective and has high reliance on qualitative assessments and may overlook some positives or some opportunities. For example, entities that have a significant growth potential might be undervalued when using this method. We now look at the venture capital method. The venture capital method is often the most relied upon, especially for early stage and growth stage startups. It allows investors to project future returns based on exit scenarios and terminal value, making the preferred choice for venture capitalists. In the context of Africa, applying the VC method requires significant adjustments due to the unique challenges of the continent. For example, political instability, fluctuations in policy, currency fluctuations also pose challenges to the valuation because of changes in currencies. As a result of these factors, valuations for African startups are generally lower compared to those of more stable developed markets. Investors need to account for these heightened risks by adjusting the discount rate, typically increasing it to reflect the perceived higher risk of operations in such environments.
Yeah, Rutendo, just before you continue, I just want to kindly remind you that we want to move into some question as well. So I was just wondering whether we are good on your side before you continue. Yeah.
Yep. Thanks, Tony.
Good.
Almost done, and we'll move on. I'll just look at an example, a quick example here. We look at the VC method. It starts with the end in mind. We look at the terminal value of a similar group of startups, and then we look at our expected return on investment, which is typically 20%, but for startups and the fact that it's in a developing market, we tend to heighten that up. And we've, in our illustrative example, gone with 30%, 30 times the multiple. A division of the terminal value and the return on investment gives us a post-money valuation of 2 million, assuming for that funding round, we wanted to raise 500,000. So we then come up with a pre-tax valuation of 1.5 million. We also need to remember the effects of dilution. So because you have more funding rounds as an existing investor, the more funding you raise, the more you get diluted. Okay. Some of the pros and cons for this approach is it's one of the most useful methods used when calculating a valuation for a pre-revenue business. And one of its drawbacks is that it's highly subjective. I'm aware we're probably running behind time here, but the last method here is the first Chicago method, and it takes into account just a probability weighting. So we think of possible outcomes. A startup has different possible outcomes, and then we grade them into a base case, an upside and a downside case, determine valuations under each of those scenarios, and then attach a probability, and then overall valuation will be calculated. Let's move on, Edna. It accommodates high uncertainty and is also very subjective based on the probability assignment. And what's important to note here, this is a post-revenue valuation method. So we're now at a position where the startup or the venture capital has gone through prototype testing and is now revenue generative. So you can use this method to determine the valuation. Okay, over to you, Edna.
Okay, Tony, I'll quickly just go through this, and then after this section, I'll wrap up the methods and we can take some questions, yeah? Thank you. So here, I'll just quickly run through some very classic business valuation methods, which are also applicable to startups post-revenue. So first, we have the DCF method, which starts with projections of future cash flows of an asset or a business, and then discounts them back to present value using a discount rate to estimate the intrinsic value of the business. It's key for valuing companies based on their future potential. With regards to startups, it's a bit challenging because they may not have stable revenue forecasts. And second, due to their high inherent risk, they are likely to be subjected to a very high WACC, which is the discount rate. Second, we just quickly talk about the market approach, which compares firm value relative to peers. It can be done in two ways. We have the public company comparables, so you compare the firm value with peers who are publicly traded using some multiples, and we have precedent transactions approach, which you base the comparison on acquisition companies of peer acquisition prices of peer companies in the recent past. So with regards to startups, again, they are often unique with few direct comparables, but it is not impossible to use this method. And a good example I would like to highlight is the social media company Instagram, which during its startup stage was valued at $1 billion, which had been drawn directly from the success of Facebook that had a similar business model. So let me just quickly wrap up this section on the methods. And it is important to note that one, the African context is marked by unique circumstances like political instability, market volatility, limited infrastructure, and this usually shapes the application of all the methods that we have just discussed. So that means it's important for you to make your adjustments accordingly. Remember to keep your analysis simple and then use a combination of methods to determine a concluded value range, because each one has its strengths and its downsides, its own different biases that are embedded. So it's good to have various points of view so that you can conclude on something solid. Third, enterprise value is determined by a combination of internal and external factors. So you need to understand these various drivers and their interactions so that you can better assess the startup's potential. And also remember, even if they have a very fast growth rate, they cannot grow faster than the economy indefinitely. So during your financial modeling, remember to adjust the growth rate so that it hits a more sustainable level at an appropriate time. Rutendo?
Okay, great. Thanks for that. In conclusion here, we just have up on screen some insights that you can consider when assessing a decision, an investment decision that you're going to make. You need to evaluate the strength of the founding team. You need to understand the lay of the land, which is the competitive landscape, and also assess the product market fit. Some strategies for overcoming high uncertainty and limited data is performing scenario analysis and use of pre-revenue valuation methodologies, which we've just talked about. Great.
Excellent. So I'm sure there's still a lot that you could present, but I'm sure there's also a lot of interest. So what I could suggest, I know you probably have a couple of more slides you wanted to share, right, Rutendo? Am I correct? Yeah.
That is correct, Tony.
Okay, what I suggest we do, the way we do it, so we're gonna take some questions from people. I have a couple of questions I wanna ask you, and after that, I want to open the floor to the people that are actually listening to us. Please, guys, start preparing your question. And what I like to do is slightly faster this way. If you could raise your hand, we're gonna unmute you. When it comes to that, we're gonna unmute you, and you can ask your question directly. So have your camera on, when possibly. And if not, obviously, my colleague Brian obviously will read the questions, and then we can take from there. But there was, as you could see, so that's the great thing with the Marys. They always have a lot of insight. I'm sure you are seeing obviously the value here, you attending this session. So my first question for you, I'm gonna go. It's a very simple question for you. I'll start. So Edna, so what role would you say government policies and incentives play when you actually have your startup valuation process, especially in the context of climate finance? If you can respond to that.
I think you're reading my mind because I have a slide on that later on.
Okay.
But if I may just quickly summarize what I was going to talk about on the subject, it's that government policies and incentives play a crucial role in the startup valuation process, particularly in this concept, because these startups rely heavily on an environment that is shaped in a very big way by regulatory frameworks and financial incentives, because they affect the company's financial outlook and potential for growth. They're very key to the valuation process in the climate finance space because they influence everything from cash flow projections to risk factors to market demand to access of funding. So I would recommend that everyone understand how these factors shape a startup's financial outlook, because it is critical to arrive at an accurate and sustainable valuation, particularly when climate-related risks and opportunities are embedded in the business model.
Excellent. Thank you very much for that. There's one thing I want to do, because I know that there is a lot of good information here, but I want to give an incentive for people to participate. So what I would say is actually here is what I knew already that we're going to struggle to scramble all the good knowledge that we want to share with you. So I've agreed with Edna and Retendo. We've done it the last two webinars. It was very successful to avail a number of slots for you to have one-to-one with Edna, with Retendo, and maybe Edna could join. So Brian, so I know you are here, you're around. Please, if you can drop the link for the meeting, the link that people need to obviously click on, and you go and book a one-to-one meeting, and to go through some of those points that you want to go through, especially if you have a business startup, you like to understand a bit better. That's the time for you to do that, right? So as you know, those are, I'm sure I'm not lying saying that. You wouldn't mind me saying that. And at Retendo, you get a consultant, so normally you charge for your time. But we've agreed that obviously you're gonna avail some time for us to do it. That's first come, first serve, first come, first serve basis. So if there is anyone left after that, guys, like I say, I've warned you before. So Brian, just drop the link there, and then I'm sure. And the additional incentive that I want to give to people that take action is, if you do that, I'm gonna make sure that we give you a copy of this presentation, but that's only gonna be for people that actually are keen enough to go and book the meeting. So that's I know a hand is already raised. Let me just ask a very quick question to Retendo, and we can move to the question. Yeah. So Retendo, so how do you factor in the increasing regulatory pressure in climate-related businesses when it comes to valuing startups in the green space? And after that, we take questions. And Peter is already on.
Thanks for that, Tony. I think it's important that we highlight that the regulatory piece is quite important, and to some extent the cornerstone of climate focused startups, as they are. So the regulation and incentives for climate focused can significantly influence the financial performance and the risk profile of a startup. So a startup receiving financial aid can be viewed less risky. I think I did talk about the element of de-risking because you've got a climate finance solution extended to you, and especially if it's through a DFI or one of the larger government bodies. So this has the effect of uplifting your valuation. It is essential to integrate your regulatory influences, such as your policies, your climate goals, and compliance costs into your financial model. And adjustments to the revenue projections and the discount rates also come without mention because of the climate finance solution that you have. So startups that align early with the evolving regulations or are able to comply tend to receive better incentive programs and will be valued higher and have a better long run.
Excellent. Thank you very much for that, Rutendo, and also thank you for keeping that obviously straightforward and not short as a response. I think I don't know if Brian has had a chance to share the link. If not, let me just drop the link here. So that's what guy you could see. So if you want to jump on a one-to-one and then with Numeris, and you can go to some of the questions. I'm gonna start by Peter here. So Peter, what I'm gonna do, I will unmute you. Yeah. So and you can ask your questions. Where's Peter? I think I had Peter in the end. Yeah, I see Peter. Yeah, Peter, 1 second. I'm coming to you. Why? Okay, Peter's here. Okay, so I'm just gonna ask you to unmute and then lower your hands. Peter, are you on? Yes, you're on. Ask your question, Peter. What's your question? And okay, before we do that, please, let's ask just one question each of us, right? And make it short so that I can collect some other question after that. Peter, over to you, please. And tell us where you're joining from. Peter, are you speaking? I can see you're not speaking?
He says he cannot unmute. Maybe you need to unmute him.
I've unmuted him, that's for sure.
Oh, okay. Yeah, Peter, you can ask your question.
Yeah, I've unmuted you already.
Can you hear me?
Yes, you
Yes.
can hear you now. Yeah, go ahead.
Okay, great. No, thank you, Tony, and many thanks to the team from Numeris. My question is, my name is Peter. I'm joining from Nairobi, and I just started a company that will be doing CNI solar here. My question is on the, you mentioned or you talked about, I think regarding specifically the Bacchus method, the scorecard method, and the risk factor methods. How do you guys arrive at that comparable sort of base valuation from another company to which you apply the factors that you're applying in each of those methods? Thank you.
Happy to respond to that question, Tony. So what we do as a base, Peter, is typically for African markets, the ideal would be to look for peer companies that are similar in terms of the industry, size, and nature, and then use that cohort or that group as our basis for determining the market value. You'll find now there's a number of nuances in cases where it is the business or the asset we're trying to value is quite unique, and you don't have a similar comparable company across Africa. What we tend to do is extend that sort of encatchment net to other geographies, but taking into account the fact that we're no longer looking at a Africa-specific entity, and then we'll bring into account the adjustment for geography, political risks that would need to be factored in. So if you're looking at a one-on-one comparison for a group of companies, we can only identify the peer set, call it in Australia or in Europe. We need to adjust that value base to Africanize it per se and bring in adjustments to that value. And then that will be our working base.
Okay, excellent. So are you satisfied with that, Peter? Hopefully you still.
Yeah, I got a thumbs up, yeah.
Okay, great. Do we have any other questions? I think Peter Mubanda also had a questions. He said that I need to ask for him. I didn't see the question in the chat. But Peter, would you be keen enough to ask that in public, if you don't mind? Peter Mubanda.
Yes, I'm on. Thank you for unmuting me, finally. Thank you for the presentation. The team has done a great job. I want to touch on the Africanization of it all, because it seems you've brought a European-centric model and are trying to jam it into the African context. Pre-COVID, we started an off-grid solar company in Uganda. We took on the Europeans that were here. I think Solar Now, Copper came in, and there were a couple of others. What we saw, even as a startup, is commercial banks wouldn't lend to us. Even if we went to family and friends, there wasn't enough of the commercial banks to lend to us. All the government policies that were in place, we understood, and we knew how to play the game, if you want to call it that. But yet the funding that the Europeans were bringing in through the various ESGs, et cetera, or donor investment funds, et cetera, would go to entities that were European-based, operating in Africa. So for instance, in Uganda, MTN operates, MTN starts an off-grid solar company. Who gets the money? MTN. What's the telephone company in Kenya? Safaricom. They start M-Copper. They've got a bank behind them. What happens? They come to Uganda. What does Ugandan public funds do? They give to M-Copper. So how can typical African mom and pops, as we call them in the United States, mom and pop entrepreneurs, get into this valuation thing that you've just discussed here? Because it seems to me that we would have to bring in European or American counterparts. And the reason I'm bringing this up is in all your examples, I can't recall you mentioning one African company that was successful. You brought up Instagram and Facebook, which we all understand, but where are the African entrepreneurs where you can say, even in South Africa with the vibrant Joburg Stock Exchange, you can point to a climate initiative company that has done pretty much or something along the lines that you brought up? It's a long-rounded question. I think I had a couple of questions in there, so hopefully you understand what it is I'm asking. Thank you.
Thank you, Peter, for your question.
Do.
So,
thanks for that.
Rutendo, who want to jump in?
Great, thanks, Tony. Peter, thanks for that question. I think I can safely say you're not the only person who has that sentiment around the Africanization of such approaches. And I think there is a good call to order to actually have an Africanized approach or an Africanized way of assessing entities in order to get across the line and actually have an investment funded from outside Africa for Africa after having been assessed in an African nuanced or African specific environment. I think what's important to note there is because we find that the market has very few, and in most instances, no comparables, no peer sets that we can rely on. In some instances, that financial data is not even available. I think there's a call to organize or have platforms where such information, where such financial data is publicly available, and sort of develop or derive a database or a platform where such analysis can be done, and thereby forming a story, an African-specific story about our experiences, how the fundraising process works, how we do, stemming right through from due diligences, capital raise, right up until a project has been funded, and we do evaluation for these entities. So I think there is a gap in community and society, and there's definite opportunity around Africanizing some of these approaches and coming up with a backbone that's strong enough to say, this is our valuation, this is our approach. We take it to market, and we're able to present to any bank or any funders our valuation or results of our operations that they are comfortable and happy with.
Excellent. Thank you very much for that. So we have about, let's say, 10-minute maximum. In fact, I want to do less than 10 minutes. I could see, I'm probably going to take one more question. By the way, I could see that I already have 3 people that are actually 4. Thank you very much, guys, for that. I appreciate that. So as I say, guys, so make sure that you get to speak with Rutendo. You can go a little bit more in details, in depth with some of the questions that you have applicable to your own business. So don't hesitate. So, and could see in the chat, I had a question from Margaret Toll. So Margaret, if you're around, so would you mind asking your questions? And so that, and after that, we could then start wrapping up. And like I say, so people that ask the question, I'm gonna give you the full presentation. Yeah. So for the other guys, hey guys, you got it there. I'm giving you the opportunity to do that. So Margaret, do you want to ask your question? Yeah, I'm unmuting you. If not, if somebody else has a burning question, raise your hand. We take it, and then we're gonna start wrapping up. Or if not, okay. I don't think.
Sure.
Okay, Margaret.
Hello, can you hear me?
I can hear Margaret. How are you?
Yes, I'm good. And yourself?
Very good, very good. Where are you joining from?
I'm joining from Dakar, Senegal.
Okay.
I'm a manager at a more traditional PE fund, so it's
Okay.
very insightful to learn about startup valuation.
Brilliant.
My question was with regards to the first methodology that was shared actually on the benchmark value. I was just wondering how we should think about that benchmark value. Is it an abstract number that we come up with, or is that number itself benchmarked as well? So I remember it was 50K, and I was just wondering why 50K? Why wasn't it another number? Because that itself may have some level of bias, depending on how we get that figure.
Great. Thanks for that question, Margaret. So you remember I did mention this as an assumed value. What tends to give that value a shape is an understanding of how other peer sets are performing in the sector. So it's not a prescriptive value. You find larger organizations, larger sectors or startups in larger sectors. You can compare the health space to tech or education. Those will have different benchmarks, and there's an industry accepted sort of range for those weightings. 50K was just an illustrative example, but you now need to take a step back and say, typically, how much would you allocate the quality of a management team to an entity that is in the tech space? Is that any different to someone who's doing a similar assessment in the renewable space? So there is some thought that goes around actually determining that assigned weighting. It's just not an abstract number. It needs to be supportable, and you need to have some logic into determining why you've put 50 and not 100, like you rightly asked.
Excellent. Superb answer. So thank you, Margaret, by the way, for joining, and we appreciate that. And yeah, so let's have conversation. Margaret, and if you can as well, so just book a meeting with Rutendo if you have some other further questions, and we can arrange for you to have that one-to-one. So is there any last burning question, or why we're just gonna now wrap it up? Yeah, I don't see. Okay, let me just see. Okay, Wangari Chege. Hey, let's go, Wangari. So I'm just gonna allow you to ask your questions, to unmute, but please make it short so that after that we need to wrap it up. Yeah, Wangari.
Yeah.
Over to you.
Can you hear me?
I can hear you very well. Thank you for joining, by the way. Where are you joining from?
Yes, I'm joining from Kenya, Nairobi.
Excellent.
I work with the Dili Solar Hub, and one of our major goals is to work with the marginalized communities in Lodwar, Kakuma. So I'm just wondering, when you serve services, you provide services maybe in Nairobi versus those marginalized where you don't even have transport. So your needs are really very different from somebody who's serving from an urban place. So how does that also play into these metrics on arriving at how you value a company?
Do you mind taking that again, Wangari? I just want to confirm what you're saying. So I'm valuing two companies. One is serving, call it an underserved area, and because of sort of the sector or the space where they are, they need to get transportation to go and conduct the service. Is that what you're saying? I might have missed that question, Tony. Do you mind unmuting her again?
I think, yeah. One second. Let me just unmute her again. Yeah.
Okay, can you hear me?
Yeah.
Yes, now I can.
Yes, thank you. So what I'm asking is, we serve in a very marginalized community in north of Kenya, in Lodwar. So question becomes that when you're examining us versus a company that is providing solutions, let's say from the capital city, which is Nairobi, how do you also factor in that the demographic that you're serving is also very different from what say somebody is serving? Because some of the people we are serving, we also don't have the difficulties are very totally diverse. So how is that factored into the model? Because that is also a key pain point in our operations.
So let's take, for example, the risk factor summation method. You can actually flag that as a potential risk, and then you weight it, because what you're saying there is the suitable peer set has technologies or is in a position of a more favorable infrastructural setup, which you don't have, and that in a sense will affect either your go-to-market strategy or your rollout strategy. So that is a risk. You now need to assess how much of a risk that is, thereby adjusting a peer set that doesn't face that risk. So it would typically be in the risk factor summation method, a negative adjustment, which will result in a lower valuation for that entity. I don't know if I've answered you correctly there.
I think she's probably unmuted, but let me see if I can squeeze one, maximum two questions. But that's it. I think there was
Sure.
a ID Ido who was wanted to ask a question. So let me just unmute you. You should be unmuted now, and you should be able to speak. Can you hear me? Yep.
Okay, yes, I can hear you.
Yeah, I think you're breaking off. We couldn't hear.
Yeah.
Could you repeat? Could you repeat? Okay. So yeah, unfortunately, it won't work because I think you.
Thank you so much for this opportunity. Can you hear me now? Is it better now?
Yeah, go
Yes.
go on. Yeah.
Okay. Is it better now? I guess
Yeah.
it's my network.
Yes,
Okay, yeah.
yes.
I'm just really curious. Yeah, sorry about the network glitch. I'm just really curious to know. I'm Lola from Nigeria. I help startups within the climate space, renewable energy companies, to raise funds and also get them investor ready. Well, for now, I'm in between jobs, but I'm just trying to gather all this knowledge and skills to be able to scale up experiences. So part of what I do is similar to this, and some questions come, or sometimes I get to imagine what qualifies you to determining the value of a company, more like as when you're in a finance role in an organization or a CFO. Is there a particular qualification, or what's the requirement, I mean, for you to be able to prepare the evaluation report and it's acceptable?
Okay. I think I understood that. So basically, you want to know what's the pathway to end up working like Retendo, right? So Retendo, if you can respond to that in a couple of minutes, and then we wrap it up, please.
Sure. Firstly, I will extend the invitation to her. If she books a one-on-one, we can have a more detailed discussion around that. But just to answer you in summary, I think much of what we do is finance driven, but there's lots of elements around on the job training. So you do come in with a finance qualification to understand the numbers and how they play. And then afterwards, you also look at the experience or the kind of work that you're doing, and you build onto that.
Excellent. So Lola, you understood that. Please just book a meeting with Retendo. Not only is she going to give you a lot more information, you're going to get a copy of this presentation, because like I said, there was more slide that they wanted to share, but unfortunately we just can't have the time. But that's what I'm saying, ladies and gentlemen. I think we definitely need to have another follow-up on this talking with other topic, so that we can explore that a little bit more into detail. What I want to do, while I'm wrapping up, I want to run a very quick post survey for the end, because it helps us to understand how can we serve you better, right? So I'm just gonna launch it just right now, and I want you to have a look at that, and that would be very much appreciated. So the first question is, how valuable do you think this webinar was for you? Very valuable, somehow valuable, not valuable. You should have an idea, right? Whether you like it or not. So please just let us know. That'd be good. So which topic do you want us to cover next? So financing strategies, mastering off-grid solar financials, working capital, financial options. Yeah. And then obviously there's another, there's a third question. Would you like to be contacted for further conversation on startup valuation? Yeah. So I'll give you no more than a minute to complete that, and then we can wrap up. And why people are are completing this survey. So Rutendo and so what is the last word that you want to share with our audience today? I think we had a lot of people participating. Very happy about that. So thank you very much. But what do you want to tell them?
I'll let Edna go first.
Okay.
And then
So Edna.
I'm sorry, I was still muted. Anyway, if I were to conclude everything that we have talked about, the main thing I need to emphasize is that we need to understand both traditional business metrics, which of course drive business value, and also the unique factors that influence environmental innovation and startups in this space. So as we continue to see rapid growth, it's essential to adapt our methods to better reflect the complexities and opportunities that these startups present. So by incorporating new methodologies, besides like the classic ones I mentioned, the DCF and the market approach, and focusing on both financial and societal impacts, we can improve the accuracy of startups valuations, especially in this dynamic space.
Excellent. So Rutendo?
Thanks, Tony. I think one point that comes into mind is when you look at climate-focused startups, their effect is long-term in nature, and there's a lot of uncertainty. So as you sort of set up a fund, a VC, or are looking to value a startup in this space, I think it's always good to have an extended valuation horizon in mind, where if you're an investor, you should adjust your financial models to reflect extended timeframes, typically in the climate sector, because you've got a sort of a longer term horizon. So look at a 10 to 15 year forecast and beyond, not just limited to the typical or the standard 5-year forecast for traditional valuations.
Excellent. So let me now end up and share obviously the result that we had. So for the polls, so we'd be happy to know that 78% of people actually find it very valuable, and somehow valuable as well, 22%. So 99% actually, no, 100% basically. That's great, basically. You find it valuable. So we're very pleased about that. So what topic do you want to cover after that? So mastering off-grid. Look at there's a lot of people from off-grid solar here. That's great. And after that, financial strategies and financial modeling. And it's also great because you have 85% of people that say, yes, please reach out to me. There's one person that said no. That's great. That's why I won't contact you, right? So actually, I might just do that just to change you a little bit. And free.
I guess we call those outliers, Tony, hey?
Yeah.
We always need them, right? maybe it's one of you voting. Yeah. And also, three people say, obviously, they don't know yet. Oh, make up your mind. So, but ladies and gentlemen, like I say, so it was really for me a pleasure to be talking to you today. I think we've had a great conversation. We can all agree. Yeah. So that was a great topic. We couldn't cover everything, but today we've explored, the valuing startup, especially those in the climate space, and you can see it's both an art, but also in science. Because at some point, some of you would have been like, where am I actually exactly? So you need to know how to marry the two. Yeah. So they have unique challenges, those startups, climate space, and we discussed the best practices. We've gained some insight on how investors would assess those early stage climate focused ventures. And I hope the session gives you the tools, but also the knowledge to better navigate the valuation landscape, whether you're a founder yourself looking for funding or you're an investor seeking for the right opportunity. So hopefully you learned something. And before we close, I want to remind you of this exclusive opportunity, like I say, the one-to-one with Rutendo, and then that we've given to you, and where you're going to get personalized advice on your startup valuation. And we've opened up some slots, first come, first serve basis. So if you're serious about refining your approach, this is the opportunity for you to do that. And thank you as well for the feedback. Thank you for supporting us, Renewables in Africa. We're looking forward to seeing you in another webinars. And for the time being, don't forget as well, so there's a link for our social media. So connect to us, to our YouTube. Please do that and share the love and share the those links with your network. And for me, I see you another time. It was a pleasure to talk to you today. As you can see, we always bring you very, very valuable topics. And Numeris is always top of the game, world class. Thank you very much, ladies and gentlemen. So we're gonna finish with a little bit of music, guys.
Thank you, everyone. Thanks, Tony.
Bye.
Thank you.
Footprints mark the golden sand. Voices harmonize the song. Nature calls and we belong. Let the rhythm take you high. Raise your hands up to the sky. Feel the energy ignite. Celebrate the day and night. Stars that twinkle in the night so bright, guiding paths with gentle light. Echoes of the past we hear, carried on the wind so clear. Colors blend in harmony. Life's a vibrant tapestry. Every beat a story told. Ancient wisdom pure as gold. Let the rhythm take you high. Raise your hands up to the sky. Feel the energy ignite. Celebrate the day and night. Take you high. Raise your hands up to the sky. Feel the energy ignite. Celebrate the day and night. Rise of the sun in the morning light. Drums in the distance take flight. Heartbeats echo through the trees. Dancing shadows in the breeze. Feel the pulse of the ancient land. Footprints mark the golden sand. Voices harmonize the song. Nature calls and we belong. Let the rhythm take you high. Raise your hands up to the sky. Feel the energy ignite. Celebrate the day and night. Stars that twinkle in the night so bright, the sky.